Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, February 15th, 5:12 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Let's get right into it. State of the market, we're in a consolidation. We'll check the charts momentarily, and you'll see what's going on. Basically, we graduated up from a lower range that we fell back into over the last couple of days to an upper range, which is a good sign for the market, but still got a lot of battling to get through, and we need to see some improvement in the action of some leading stocks. So let's check over here in the trend gauge. You can see leading stocks, we got them marked neutral, no changes to the arrows. The big arrows, some changes to the little arrows, as today was a productive day in the market, but leadership neutral. 21-day exponential moving average still negative as we're trending below that across the major indexes. 50-day, same thing. 200-day moving average. The arrow improved as we hadn't got another close above the 200-day on the S&P 500. We're going to look at the charts momentarily and see how we've been playing volleyball back and forth with the 200-day moving average being the net momentarily. So what happened today? So overnight, supposedly, the news was Russia pulled back some troops, so there was a gap up, and the gap up didn't fade, which is a good sign, a little bit different from strength that had been fading over the last 3 days in the market, and the S&P 500 did close back above, although just barely, but still above its 200-day moving average. So big numbers on the day. G6, the growth index, up 3.2%. Good sign here. Smaller and mid growth has been showing relative strength over the last couple of weeks. About a week and a half. S&P 500 up 1.6%, NASDAQ 100 down 2.5%. Up 2.5%. Dow Jones up 1.2%. Mid caps up 2.2. Russell up 2.8. 60/40 diversified stock bond portfolio up 1.02%. In-house, we were slightly negative today, as we're still playing it light after the distribution over 2 of the past 3 days and multiple closes below the 200-day moving average. But again, we're looking for some more strength to put some money back to work in the market. We have 3 positions right now. They're all in commodities: gold, oil, and steel. And oil and gold pulled back today on the Russian news. So we were negative on the day. That's after 2 big outperformance days last Thursday and Friday, so giving back a little bit of that gain over the last couple of days. But we can recognize an unhealthy market, and we're in one right now, but the market is trying to put a goal line stand up and show some positivity, and we'll be there if and when it does. Speaking of being there, this is the team at Revere that's there for you, protecting capital in a sideways and down market, participating in market uptrends. You're interested in a common sense approach like this, you can contact any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the charts and the tail of the tape now. So let's show the S&P 500 very quickly here. Let me blow this up. So go back to 2 weeks ago on a Monday, 124, huge shakeout in the market. This is put in the bottom ever since then. We went sideways for 4 days, strong close on a Friday 2 weeks ago, and then big follow through on Monday. So this was the follow through day. And we followed up with 2 days of strength on that until we came into the vicinity of this downtrending red line. That's the 50-day moving average. So 4 days of pullback there, and then another gap up on 2/9. But then 3 miserable days after that, combined with started last Thursday morning when we had terrible CPI, terrible inflation news, and then we had one of the big Fed guys come out and say he wanted to raise interest rates by a full % before June or July, and the market hated that on Thursday, hated it on Friday. Monday made a lower low but closed in the upper part of the range. And mixed into here is, the whole Ukraine-Russian saber rattling nonsense that's going on. So we had 2 days of a close below the 200-day moving average. So this put the kill to this follow-through day that we had on 131. So now we're looking for more strength and leading stocks to emerge. And we did the first step today, and you'll see when I get to the tail of the tape here, one of the things that we were looking for, we did in fact come to fruition today. So you see the gap up, but more importantly with this gap up, a couple of times during the day we tried to pull back and give back the gains. First right after the open, but we didn't break the 30-minute low, and then again midday, but we didn't break the 30-minute low, and then again after Biden was talking and threatening Russia, we tried to pull back, but again we held the low and finished strongly near the high of the day. So all in all, this is certainly a constructive day in the indexes, even more constructive if you want to look at some of the bigger gains in individual stocks, and we'll touch base on a couple of those momentarily. So where are we now? First close above the 200-day moving average on the S&P 500, coming into the declining 21. So really, realistically, all this is a bounce off of a harsh 3-day pullback. Okay, just like 2 weeks ago, we were talking about how this pullback was just, at the time, a normal pullback from a 4-day sharp up move. So I'm not getting too overly excited by this after 3 days of negative action, having 1 day of positive action, and really not even reclaiming half of what we gave up off of the top from 2.9. I'm not getting overly excited. I've seen these multiple closes, a close here and a close there, above and below the 200-day moving average. And while that is a very critical area, because you know how much risk picks up once we get under the 200-day moving average, the bulls keep reclaiming that line. We're not going to guess and go all in and saying, oh, we think the bulls are going to reclaim it. We're going to wait to see the decisive proof. We're going to wait to see good action in leading stocks before we risk any capital. So right now, next line up is coming into this declining 21-day moving average. So let's go over here to the tail of the tape. Still fighting. Strong dollar, inflation, Fed tapering interest rates in Ukraine and Russia, but the market always climbs a wall of worry. This just seems like quite a bit more than normal. Put call started out very high on the day, but decreased as the market stayed strong. VIX dropped quite a bit. We want to look for this to get below 24. That's kind of like a sweet spot right now, 25.7, but down 9.3% on the day is a plus for bulls. Fear and greed is at 37, so there's still some fear in the market. Now, the change from the last time I did a video, and really the change from yesterday, bull case versus bear case. What are we looking for to get back on the bull side? A reclaim of the 200-day and initiation of a rally. So we got the reclaim of the 200-day today. Got some good action in leading stocks. We want to see some follow through to that. Bear case was the 133 follow through day failed, and we broke back below the 200. We had red arrows pointing to this on the last video, but back above the 200-day, trying to rally. We're right now trying to get back on the bull camp, and we're going to see what the market does over the next couple of days to help us decide. As I mentioned, the news this morning, Russia pulling back some troops supposedly, although right after it came out, Russia said, we didn't pull them back. They were just doing an exercise and it was already pre-planned. Whatever, the market didn't give back the gains after that, and in fact, they didn't give back the gains after PPI was just absolutely terrible. As bad as CPI was last week, PPI was even worse. PPI is producer price. So if there's inflation at the producer level, they have to make a decision whether or not they're going to carry it forward and pass it on to the consumer. But the PPI was even worse relative to what the expectations were versus CPI last week. But again, 3 attempts at a sell-off during the day, and we didn't get it, even though this is very clearly inflationary what the PPI numbers are. So coming into the day, I was watching. Key thing I was watching, what was the S&P going to do versus the 200-day moving average, which we had 2 closes below. We did the gap up right into the 200-day, tried to sell off 3 times, and it was bought each time, and we did in fact get a close above the 200-day, so this is a positive sign for the market. Action, I talked about, the gap up, tight sideways all day long, close near the high of the day, that's all bullish. The gap up on the Russian troop pullback, reclaim the 200-day, and bottom lining it, which we always want to do. Gap up held, close back above the 200-day. That's a positive for the market. No changes to the portfolio today. We have minimal exposure. We have like 91% cash, 3 positions in NRGU, Nucor, and Newmont Mining. Sectors that were strong today, the SOX, Jets, which is a reopening play, obviously, biotech, banks, transports, and retail. On the negative side, oil services was strong, but XLE and XOP, as well as gold, silver, and gold and silver stocks and utilities were weak. So let's take a look at the key levels here now on the S&P 500 and compare it to the chart. These 3 levels above, we're still underneath them. That's the breakout range after the prior breakout range from 4740 to 4800. This is back here at the end of December. Breakout for about a week and a half, but we failed. Next range is the prior all-time high range, 4650 to 4740. This is while when we broke above this prior pivot here, all of this range in here, which we broke back into after we failed at all-time highs at 4800 when the Fed started scaring the bejesus out of the market. So up above us, we've got the declining 50-day, that's the red line. We've got the declining 21-day at 4505, that's the green line. We're closed just a smidge below the declining 80 MA, but we did, as I mentioned, excuse me, get back above this 200-day moving average here. So our prior close, volatile chop, lower low, not good. Some improvement today as we got back above, got out of this range here, which we were in, which is really the shakeout range that we collapsed back into last Friday and yesterday. Got back out of that. So one step at a time, back to the upside. Market continues to cooperate. We'll continue to put exposure back on. Let's go to the NASDAQ 100 now. This is still below the 200-day moving average as it's been weaker. Note this relative strength. This peaked back on 1130. So ever since then, over the last 2.5 months, the NASDAQ 100, which leads the market higher, leads the market lower, has been underperforming the S&P 500. This usually doesn't persist, and we're looking for a turn here. And one of the turns we want to see is one on a relative basis, we make a new high, maybe before price does. Okay, so the last 2 days we've had outperformance. You can see this line going up the last 2 days. NASDAQ 100 has outperformed Monday and Tuesday. We had a red close on the S&P on Monday, but a positive close on Tuesday. Today we're up 2.5% versus 1.6% on the S&P. So little bit of strength here. There's been pockets of strength in the NASDAQ 100, but for the most part, the trend has been down since 1130. So we're looking for some relative strength in here. I'm going to show you where we're seeing some relative strength in a moment here. So that's the NASDAQ 100. Let's look at the Dow Jones Industrial Average. Much better looking price formation, really just going sideways from a relative strength standpoint over the last 3 weeks. But notice since 1130, when we peaked on the relative strength on the NASDAQ 100, this is when we bottomed on the Dow Jones at the same time frame, and that's been outperforming, and that's typical. The Dow Jones Industrial Average is where money goes to on a flight to safety as it flees higher beta growth and tech type names. So you can see relative strength on that going back through 127, just kind of sideways action over the last 2 weeks. Closed right below the 200-day moving average. This went from being above the 21, the 50, and the 200, had a harsh 3-day sell-off, very similar to what we saw in the S&P 500, and a nice move up today on the Dow Jones. Let's look at mid caps, MDY. Now look at the relative strength in these mid cap stocks. Maybe it's just a case where they're just flat. Everybody sold everything that they wanted to sell, and it's time to start taking some probes back into them. So very clear relative strength, although we're below the 50 and the 200. We did close back above the 21 today on the mid cap index. And on the small cap Russell IWM, also back above the 21-day, and it's flattening out now. But right above, we've got the declining 50-day, and then above there we've got the declining 200, because we peaked all the way back at the beginning of November in small caps. This whole way down until they bottomed right now as of February 2nd. But now over the last 2 weeks, we've been seeing strength in small caps and mid caps, which brings me to the G6. And I want to go through these 6 charts right now. We want to start off with IWO, which is Russell Growth. And you're going to see relative strength there. First close back above the 21. Compare this series over the last 3 weeks of higher highs and higher lows to what we're seeing on the big cap index, and this just frankly looks a lot better. Here you're seeing chop all over the place, and especially underperformance over the last week or so on the S&P 500 relative to IWO. The pullback over the last 3 days was much tighter relative to the price range. And then, of course, you can see over the last 2 weeks, relative strength, higher highs and higher lows. So this is a good sign right now. We've got, I believe we're going to see 4 of these 6 that we track that are in the G6 above their 21, and it's certainly a start. And it's something that we learn to pay closer attention to when growth stocks really have taken a hit starting back. We've actually had 3 20% pullbacks in growth stocks. Well, let's say between 18 and 24% pullbacks. February of last year, February, March, November, December, and January of this year. 3 big pullbacks in growth stocks, and frankly, maybe it's just time to rotate some money back into them. That's what it looks like over the last 2 weeks from a relative strength standpoint. So the second ETF we want to look at here is FFTY. Not as strong as IWO, still below the declining 21. Next up is QQQJ. This is a mid-cap version of the NASDAQ 100, and another close above the 21 on here. Note the relative strength over the last week and a half. PDP, this is a technical momentum index, not as much relative strength and still below the declining 21-day moving average. ARKK, the most volatile of them, but again, making higher lows and higher highs, minor relative strength over the last week and a half, but the higher lows and the higher highs are certainly a plus. And finally, MDYG, this is mid-cap growth, closed above the 21 also with relative strength over the last 2 weeks. So green shoots, maybe we want to say, in growth land in small and mid-cap stocks, certainly something we're paying attention to. So let's take a look quickly at the holdings that we have in-house. NRGU, 2-day pullback in gas, bounced right where we wanted it to off of the 21-day moving average. We're still underwater on this, but we've got our stop clearly defined for us now. Nucor and UE, nice action today after a 2-day pullback, bounced off the 8 EMA. Great relative strength over the last 3 weeks. Let's get back to our charts here. And Newmont Mining, which had a great day on Thursday, followed through on Monday, pullback, but bounced right where we want it to at the 21 EMA today. So those are the only 3 holdings that we have in-house. We're looking, if we see some more strength in the indexes, namely the S&P 500 and the NASDAQ 100, we'll take some index exposure. If we continue to see strength in the G6 type names, we've got a list of stocks with pivot points ready to roll. Quite a few of them are in the 21 over 21 if you want to review that video from Friday. Let's take a look at some big names and how they performed today. NVIDIA has earnings tomorrow, up 9% on the day, still back above the 21, but below the declining 50-day moving average. But let's see how it responds on its earnings report. Now, if it responds the way AMD and Qualcomm did, they had a big gap up. in fact, made a higher high, AMD did, before selling off hard over the last week, but bouncing at the 200-day moving average. And Qualcomm also had a gap up, sold off hard, terrible days on Wednesday and Thursday, put a bottom in on Friday, still below the 21. So we want to see the initial reaction in NVIDIA, and it would certainly be a plus if it didn't sell off the way these big names did. Let's see what else we want to take a look at. Apple back above the 21 and the 50-day moving average today, below average volume compared to selling the last 2 days, however, and Tesla had a nice day, up over 5%, but it's run into, this is something we're paying very close attention to. Look at the 4 rejections over the last week and a half at the declining 21, up higher here back in the beginning of January, rejected again at the 21. So this has been, that would be a change in character for Tesla if it could get above the 21-day exponential moving average. And as you know, this is a stock that can lead the market higher. Note we've got our alerts set should that happen. That's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH if you want to talk to Danny and get some more information about becoming a client, or if you want to talk to any of us, he can pass the information on to us. So certainly don't hesitate to do that. So wrapping up Tuesday, February 15th, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.